Good morning, everyone. My name is Anthony Bryant, and I will be providing you all with training on executing a sensitivity analysis. This is the outline I will follow. So, before we dive into how we'll use a sensitivity analysis as a tool, let's first make sure everyone understands what capital budgeting entails, as it is the basis for applying a sensitivity analysis. Capital, from an accounting or business sense, refers to money, while budget is the plan for spending said monies. As we head into the second quarter of fiscal year 2025, our managers and several of the business's departments are just shy of rolling out this year's collection of new products and services to our customers via new production and distribution methods. In capital budgeting, we want to review and greenlight specific projects via a sensitivity analysis to assess the potential impact it may have on the company's profitability. With evaluating capital budgeting projects, we will first identify the different types of opportunities available, execute a cash flow estimation to establish which monetary fund accounts will be used to support this project, apply several financial metrics to assess if the project's risk will have any type of reward or what would be the profitability. Then we present these outcomes to appropriate decision makers for approval prior to implementation. And finally, monitor progress and conduct a review. Now that we understand capital budgeting, let's discuss what and how sensitivity analysis are used by financial experts to assess and adjust independent or key variables that can affect dependent variables. We'll also identify potential instances of risk by taking on a project and create several what if scenarios and predictions to determine the profitability of a project's success or even its failure. A sensitivity analysis has several qualitative and quantitative steps involved in conducting this process, which we will discuss on the next slide. So I've grouped these steps into their respective qualitative and quantitative categories. Our first step is to identify our key variables that can impact financial outcomes. This can include things like sales price, discount rates, and operating costs. If one of these values were changed, we are trying to predict how this would affect cash flow from a project. Next, we will implement the financial metric of NPV, or net present value, to experiment with. From there, we will establish a range of values. We want just enough quantitative data to see various outcomes by changing one variable at a time. This will help us identify any trends that are positive or negative based on the variable being altered. Next, we'll analyze the sensitivity of the outputs from the change in input variables. And finally, we'll evaluate risk based on the overall analysis. A project that is highly sensitive to small changes in one or more variables can generally be considered riskier, as we want to ideally keep any fluctuations in variables to a minimum. So as an in-action application example, we will examine if the purchase or lease of a new factory machine will end favorably with interest earned for the company over several coming years. Managerial accountants anticipate that the production capacity of the new machine will bring in $5,000 in cash flows every year for the next 8 years. This new machine costs $15,000, and the market rate of interest is 12%. Since we only have 8 cash inflows to account for, we will use the single cash flow formula to the upper left. The single cash flow formula will help us see the net present value, or NPV, of each individual future cash flow with each corresponding year. We will then combine these cash flows for a total, then subtract the initial investment paid for the machine. So essentially that's $20,373.91 minus $15,000. Which in the end gives us a net present value of $5,373.91 for the new machine. This means that the machine will gain enough interest to not only pay itself off, but it will also garner a return of $5,373.91 in the end. This would be a win-win scenario for corporate leaders if presented with this outcome. So conversely to that, we also want to expand and test out our range, and that includes our variables that we're now playing with. So from the previous example, what would the NPV look like if the interest rate as a variable was now 20% as opposed to 12%? As we can see, after redoing all the formulas and finding out the outputs, The new NPV is now just $19.13. While the machine still managed to pay for itself in the end, management might be wary of any risk or unfortunate events that could now make the machine an expense should the cash flows of the asset not produce expected results. We have to remember that within the first fundamental principle of finance, when interest rates rise, the return on a cash flow goes down because the present value of those future cash flows decreases due to the higher discount rate applied, essentially making future money worth less today. This is a fundamental concept of the time value of money, where a dollar today is worth more than a dollar tomorrow, and a higher interest rate amplifies that effect. Money is being allocated to a project, so management wants to ensure the investment not only earns money, but makes more money than what was initially spent. The desired outcomes of a sensitivity analysis are identifying variables that have the most impact on outcomes, establish a range of potential results by testing multiple what-if scenarios, ensure the project's overall output remains somewhat constant with small changes from the inputs, evaluate risk or areas of uncertainty, call for the refinement of inputs via research and more testing, and then build confidence in the decision-making process. So in summary, when it comes to making financial decisions and capital budgeting, you want it to make it make sense. If money is being applied to a project decision, then decision makers want to have confidence in knowing there will be some form of benefit or return. A sensitivity analysis is a tool that can aid in the decision-making process by exposing any areas of concern or giving the all clear and green-lighting a project. The variables, models, and financial metrics utilized in the sensitivity analysis may vary depending on the project that is being conducted, but the end goal is confidence in execution while accounting for any unforeseen or controllable variations. Ladies and gentlemen, this concludes my briefing. I've provided some references. Please take care and best towards your department's endeavors.